The bounce back, silver plus 117%. Instantly, bottom or trap. $71 per ounce, then 83 in hours. A 17% reversal that defied every algorithmic model on Wall Street. While Singapore formed physical cues, China reported complete sellouts. And a single e-commerce platform displayed prices 95% above paper markets. $10 trillion vanished in 72 hours. Yet vault inventories remained stable, central banks held their positions, and backwardation persisted through the chaos. Someone needed liquidity desperately enough to sell the most liquid asset on Earth at any price. But the physical metal never moved. When paper and reality disconnect this violently, one of them breaks. Welcome to Silver Collapse Coming, a channel built for those who've learned that markets don't reward hope. They reward preparation. If you're watching this analysis from New York, London, Singapore, or anywhere serious capital is deployed, you understand something fundamental. Decades of experience teach us that the noise drowns out the signal. Until it doesn't. We don't ask for your subscription lightly. We ask because if this level of documented analysis, supported by verifiable data, cross-referenced against historical precedent, adds strategic value to your decision-making framework, then staying informed isn't optional. It's fiduciary. Take a moment, subscribe to this channel, and let us know in the comments, which city are you analyzing these markets from today? Because when $10 trillion evaporates in 3 days while physical premiums hit 95%, geography matters, access matters, and information matters most. The global silver market experienced something unprecedented in the early hours of Monday morning. A collapse so severe it erased $2.7 trillion in value, followed by a recovery so rapid it defied conventional market mechanics. Silver touched $71 per ounce, then rebounded to $83 in less than 6 hours. A 17% move that left institutional traders scrambling to reconcile their risk models with market reality. But this wasn't just about silver. Gold had fallen $450 to reach $43.99 per ounce, losing $7.4 trillion in market capitalization, a sum 5 times larger than Bitcoin's entire valuation. Combined, precious metals shed $10 trillion in 72 hours. Assets historically considered safe havens were moving like speculative cryptocurrencies. The catalyst appeared straightforward. Kevin Walsh's nomination as Federal Reserve Chair had triggered selling pressure, but seasoned market observers recognized something deeper, something structural. Because while prices collapsed, the fundamental backdrop remained unchanged. Central banks across developed economies maintained their gold positions. No selling reported. Tether, the cryptocurrency stablecoin backed by physical gold reserves, held steady, no liquidation. The United States government had shut down operations, unable to resolve its spending crisis, not because the crisis was ending, but because it was accelerating. $9.6 trillion in United States marketable debt would mature within 12 months, the highest figure on record. This represented 33% of all outstanding government obligations, one of the most concentrated refinancing events in American financial history. And every dollar would need to be rolled over at significantly higher interest rates than the original issuance. The fiscal mathematics were deteriorating, not improving. So the question became unavoidable. If fundamentals were worsening, if debt remained unresolved, if geopolitical tensions persisted, why were safe haven assets collapsing with such violence? The answer lay not in supply and demand, but in something far more concerning: liquidity. When markets experience severe stress, when margin clerks begin making calls, when leverage unwinds faster than positions can be adjusted, institutions don't sell what they want to sell. They sell what they can sell. And precious metals, profitable for many funds, liquid in nearly any market condition, become the first asset class targeted for liquidation. The piggy bank gets smashed, not because the fundamentals changed, but because someone needs cash immediately. This pattern has historical precedent. March 2020, when COVID lockdowns triggered global panic, gold and silver initially fell alongside equities, not because they lost value, but because funds needed liquidity to meet margin requirements. September 2008, when Lehman Brothers collapsed, precious metals declined for weeks, before eventually diverging from equities and rallying to record highs. The pattern repeats because the mechanics remain constant. Forced selling creates price discovery that has nothing to do with underlying value. But this cycle presented unique characteristics. The recovery happened faster, 17% in hours rather than days. Gold partially recovered, regaining $250 of its $450 loss, a 7% move from intraday lows. Silver outperformed, 15% from bottom to bounce, suggesting that whatever liquidity crisis had triggered the selling, it was either resolving quickly While participants recognized the disconnect between price and fundamentals had become too extreme to sustain. Yet even as prices bounced, the core question remained unanswered. Was $71 the capitulation point? The moment when all forced sellers had exited and genuine buyers could establish position? Or was this simply a relief rally? A temporary pause before another wave of selling pressure emerged when New York markets opened for business. The answer would determine whether business decision makers should view this as a historic accumulation opportunity or a warning sign that more severe deleveraging remained ahead. Because $10 trillion doesn't simply evaporate without consequence, markets don't experience this level of volatility unless something fundamental is breaking beneath the surface. And when safe haven assets move like speculative instruments, when treasury yields fall while the dollar strengthens and metals collapse simultaneously, the signal is unmistakable. Liquidity crisis. The only question that mattered now was whether the crisis was ending or just beginning. While computer screens displayed collapsing prices, a completely different reality was unfolding on the ground. In Singapore, one of the world's most sophisticated precious metals trading hubs, something unusual was happening. People were forming queues, not to sell, to buy. As silver crashed through $80, then $75, then $71, retail buyers weren't panicking, they were positioning. The scene repeated across Australia, where dealers reported similar patterns, customers arriving with capital, seeking physical metal, indifferent to the paper price carnage displayed on their mobile devices. In Hong Kong and mainland China, the situation had evolved beyond queues. Silver was simply unavailable, completely sold out. Gold remained accessible, but only at premiums that reflected genuine scarcity rather than speculative pricing. Across Europe, precious metals dealers made a strategic decision that revealed the true state of physical markets. They withdrew their silver offers entirely, not because demand had collapsed, but because supply had evaporated. When dealers pull offers during price crashes, it signals something critical about inventory reality versus paper market pricing. This wasn't theoretical analysis. This was documented behavior across 4 continents, occurring simultaneously. While paper markets suggested metals were in free fall, the numerical evidence made the disconnect even more striking. Shanghai spot silver was trading at $1,199 per ounce. Western markets showed $834. The difference, $18.52, represented a 22.19% premium. This figure had compressed from the weekend high of 43%, but 22% premium isn't normal market function. It's a stress indicator. When physical metal in one jurisdiction commands 22% more than paper contracts in another, the pricing mechanism is fractured. But the most revealing data point came from China's largest e-commerce platform, JD.com, a retail marketplace serving hundreds of millions of consumers, was displaying silver at $163.35 per ounce. COMEX futures, the primary Western paper pricing mechanism, showed $83. The mathematical reality was unavoidable. 95% premium. Retail buyers in China were paying nearly double the paper price and still purchasing. This wasn't speculation. This was rational behavior by market participants who understood that paper prices had disconnected from physical availability. And then there was backwardation. In normal commodity markets, future delivery commands higher prices than immediate delivery because storage costs, insurance, and time value of money create a natural premium structure. Backwardation inverts this relationship. When immediate delivery costs more than future contracts, it signals that market participants value possession now more than promises later. Silver remained in backwardation throughout the entire price collapse. Even at $71, with paper markets in apparent free fall, the futures curve maintained its inverted structure. This technical signal carried profound implications. Every short position on COMEX, every paper contract promising future delivery, would eventually face a moment of truth. Physical delivery or cash settlement, and if physical metal was sold out across Singapore, Australia, China, Hong Kong, and Europe, if premiums were running 22% in Shanghai and 95% on retail platforms, if dealers were withdrawing offers rather than selling into a crash, where would the physical metal come from to satisfy delivery demands? The vault data added another layer to this puzzle. Shanghai Futures Exchange reported stable inventory levels. Physical metal wasn't leaving Chinese vaults, yet the exchange had hit daily limit down, a 17% decline that locked contracts at the lower price boundary. With heavy one-sided selling and virtually no two-way trading for the remainder of the session, the Chinese market was experiencing stress. But the stress was in paper contracts, not physical inventory. The vaults remained stable, the premiums remained elevated, and buyers kept appearing. The Reserve, one of Singapore's largest private precious metals vaults, released a statement that confirmed what the data was already showing. Physical silver demand had increased during the crash, not decreased, increased. The institution noted a growing divergence between paper and physical markets, and specifically warned that physical shortages would likely worsen. Not from a speculative perspective, but from direct observation of client behavior and supply chain reality. For business decision makers, this created a strategic intelligence problem. Two markets were providing contradictory signals. Paper markets screamed crisis, liquidation, panic selling, fundamental breakdown. Physical markets whispered scarcity, persistent demand, supply constraints, pricing disconnect. One of these signals represented reality. The other represented temporary distortion. But which one? Because if physical fundamentals were correct, if supply was genuinely constrained, if industrial users and strategic buyers were accumulating while paper prices collapsed, then the current pricing represented something rare in commodity markets. Temporary dislocation between derivatives and underlying assets. The kind of dislocation that, historically, resolves violently in favor of physical reality. Behind the price charts and volatility, a more sophisticated story was unfolding. One that required understanding not just what happened, but how it happened. The mechanics of modern commodity markets exist in two layers. The visible layer, where prices flash across screens and headlines declare victories or defeats, and the structural layer, where actual trading mechanisms reveal whether movements reflect genuine supply and demand, or something else entirely. Analysts examining CME futures volume data noticed something peculiar. Outside of massive dump events, the overall trading volume remained surprisingly balanced. Buy orders and sell orders weren't dramatically skewed. Net positioning wasn't showing the kind of one-sided capitulation that would justify a 40% price collapse. Instead, the volume pattern suggested something more calculated, more engineered. During overnight hours, when liquidity naturally thins and fewer market participants actively monitor positions. Trading patterns exhibited characteristics consistent with spoofing. Large sell orders appearing and disappearing, creating the impression of overwhelming selling pressure, triggering algorithmic responses and stop-loss orders, then vanishing before execution. When U.S. trading sessions opened, a different pattern emerged: wash trading. Transactions between related parties or algorithmic systems, creating volume and price movement without genuine change in ownership, designed to push prices in a predetermined direction. These weren't conspiracy theories. These were documented trading patterns observable in exchange data, patterns that have resulted in regulatory enforcement actions in previous market cycles. But the engineering didn't stop at futures manipulation. The real cascade occurred in exchange-traded funds. SLV, the largest physically backed silver ETF, began experiencing redemptions. AGQ, a leveraged silver ETF offering 2 times daily exposure, faced even more severe pressure. When these instruments experience outflows, they must sell underlying assets or unwind derivative positions. This creates a mechanical selling pressure completely divorced from fundamental silver demand. An investor selling SLV shares isn't making a statement about industrial silver consumption or jewelry demand. They're making a statement about portfolio risk management, about margin requirements, about maximum drawdown thresholds. But the selling impacts physical and derivative markets identically. The price falls, stops get triggered, more automated selling activates, and the cascade feeds itself until it doesn't. Because unlike purely financial instruments, commodities have physical constraints. There's only so much metal available for delivery, only so many vault receipts that can be transferred, only so many mining operations producing new supply. And this is where the revaluation process becomes visible. COMEX registered silver inventories, the metal actually available for delivery against futures contracts, had been declining for months. London Bullion Market Association vaults showed similar drainage patterns, not catastrophic depletion, but steady, persistent, directional movement of physical metal from exchange warehouses into private hands. The short positions, those betting on lower prices or hedging long exposure, found themselves in an increasingly uncomfortable position. Paper prices were falling, which appeared beneficial for shorts, but physical availability was tightening, which created delivery risk. Their strategy became transparent through market behavior, minimize losses on paper contracts, cover short positions where possible, and above all, keep paper prices low enough to prevent a delivery squeeze that could force catastrophic losses. Because if silver prices rose sharply while physical supply remained constrained, short covering could trigger the exact delivery crisis they were desperately trying to avoid. The ratio analysis revealed just how distorted current pricing had become. Gold and silver trade at a ratio of 57-1, meaning 57 ounces of silver equal 1 ounce of gold by price. But the historical average ratio sits at 15-1. Mining production ratios show 8 ounces of silver extracted for every ounce of gold. COMEX vault inventories hold 12 ounces of silver for every ounce of gold. LBMA vaults maintain a 3-to-1 ratio and available above-ground supply, accounting for industrial consumption and recycling, approaches 1-to-1. Every fundamental metric suggested silver was severely undervalued relative to gold, yet the price ratio remained at 57-to-1. This discrepancy doesn't persist indefinitely in commodity markets. Eventually, supply constraints or demand surges force ratio normalization. The question wasn't if, but when, and what catalyst would trigger the adjustment. Meanwhile, cross-market contagion patterns were providing additional context. Bitcoin had closed the weekend at $76,000, below the critical $80,000 to $82,000 threshold that technical analysts had identified as key support. The cryptocurrency had touched $74,500, confirming the weakness that market observers had predicted. When Bitcoin falls, risk sentiment shifts, and when risk sentiment shifts, leveraged positions across all asset classes face pressure. And when leveraged positions face pressure, forced liquidation spreads like a contagion, from crypto to commodities to equities. The S&P 500 was trading at valuation multiples higher than 1929, higher than 2000, higher than any previous market peak in American financial history. Mean reversion from these levels wouldn't be gentle. It would be violent, and history provided a clear pattern. During deflationary crashes, 2008, March 2020, precious metals initially fall alongside equities, not because their fundamental value declined, but because liquidation is indiscriminate. Everything liquid gets sold. But there's a critical inflection point when metals stop falling, but equities continue declining. That's when the bottom forms. That's when the divergence begins. That's when safe haven assets remember their purpose. The question facing business strategists wasn't whether this pattern would repeat. Historical precedent suggested it would. The question was timing. Had the metals already bottomed at $71, or was more liquidation coming before the final capitulation? Because understanding manipulation mechanics isn't about conspiracy. It's about recognizing when price discovery has temporarily disconnected from fundamentals and positioning accordingly. Before the reconnection occurs, the $71 low represented more than just a price point. It represented a decision node, a moment where two entirely different futures branched from a single present, and business decision makers faced a choice that couldn't be deferred. Because markets don't wait for certainty, they punish hesitation and reward preparation. The first scenario, the one that kept risk managers awake, was continued deleveraging. In this path, the 17% bounce from $71 to $83 was nothing more than a relief rally, a temporary pause before the next wave of forced selling. The New York session would open, and immediately the selling pressure would resume. Silver would retest 71, perhaps break lower, testing 65 or even $60, as margin calls cascaded through the system. Bitcoin would fail to hold its 74 to 76,000 range, breaking decisively lower, confirming that risk assets faced another leg down. And when Bitcoin falls, everything correlated to risk sentiment follows. The additional CME margin requirements that took effect would trigger more liquidation. Traders unable to post additional capital would be forced out of positions regardless of their fundamental thesis. Their conviction wouldn't matter. Their analysis wouldn't matter. Only their ability to meet margin calls would determine survival. Equity markets would gap down at the open. The S&P 500, already trading at historically extreme valuations, would face the mean reversion that mathematics demanded. And precious metals, despite their safe haven status, would be dragged lower in the initial phase, just as they were in 2008, just as they were in March 2020. The Shanghai Premium, currently holding at 22%, would compress, falling toward 10% or lower, signaling that even physical markets were beginning to crack under the pressure. That the disconnect between paper and physical was narrowing not through paper prices rising, but through physical demand finally breaking. In this scenario, the fundamental backdrop remained dire. $9.6 trillion in government debt still needed refinancing. The fiscal crisis still accelerated. Geopolitical tensions still persisted, but none of it would matter in the short term, because deleveraging is indiscriminate. When the everything bubble pops, everything falls together, at least initially. This was the bearish case, the scenario that assumed more pain ahead before any meaningful bottom could form. But there was another possibility, one supported by different evidence. The alternative scenario suggested that $71 was the capitulation point, that all forced sellers had already exited, that the violent shakeout had accomplished its purpose, clearing weak hands and over-leveraged positions. And now, genuine buyers could establish position. In this path, the New York session would open and the bounce would hold. Silver would consolidate in the $83 to $87 range. perhaps testing $90 by session close. Bitcoin would stabilize in its current 74 to 76,000 zone, not rallying dramatically, but no longer breaking support, providing a foundation for risk assets to find footing. Equity markets would gap down initially, then recover intraday, showing that while fear remained elevated, the selling exhaustion had arrived. Most critically, the Shanghai Premium would maintain its 22% level, or expand back toward 30 to 40%, proving that physical markets remained fundamentally tight, that the sellout conditions in Singapore, Australia, China, Hong Kong, and Europe weren't temporary panic, but genuine supply constraints meeting persistent demand. The Bank of America bull and bear indicator, showing one of the most extreme bearish readings in its history, would prove predictive, because extreme sentiment, from a contrarian perspective, often marks inflection points, when everyone expects more downside, when capitulation feels complete, when even long-term bulls question their thesis. That's often when markets reverse. The historical ratio analysis would begin reasserting itself. Gold to silver at 57 to 1 versus historical 15 to 1. COMEX vault ratios, mining ratios, available supply ratios, all suggesting massive silver undervaluation. These fundamental imbalances don't persist forever. Eventually, pricing mechanisms reconnect with physical reality. And when they do, the adjustment happens rapidly, not gradually. For business strategists, this created an acute analytical challenge because the data supported both scenarios. Paper market stress suggested more downside possible. Physical market tightness suggested deformation probable. Forced liquidation patterns indicated deleveraging incomplete. Sentiment extremes indicated reversal imminent. The monitoring framework became critical. 5 specific indicators would determine which scenario was unfolding. First, the Shanghai Premium trajectory. Compression toward 10% signaled physical weakness. Maintenance or expansion toward 30 to 40% signaled physical strength, overwhelming paper selling. Second, Bitcoin's price action. Stability at current levels suggested risk sentiment stabilizing. Breakdown below 74,000 signaled more contagion ahead. Third, equity market behavior at the New York Open. Stabilization suggested forced selling was complete. Gap down with no recovery suggested more liquidation coming. Fourth, physical dealer inventory reports. Continued rationing in queues supported the supply shortage thesis. Inventory normalization would suggest the physical tightness was temporary. Fifth, banking sector stress signals. Any official statements or market pricing indicating banking system problems would trigger immediate precious metals safe haven demand. Silence suggested the liquidity crisis was contained. These weren't predictions, they were decision frameworks. Because in moments of extreme volatility, when $10 trillion evaporates and then 17% recovers in hours, guessing is fatal. Framework-based analysis is survival. The $71 low posed a fundamental question that every business decision maker had to answer for themselves. Was this a historic accumulation opportunity or a value trap before more severe decline? Physical markets were screaming one answer through queues and premiums and backwardation. Paper markets were screaming another through margin calls and wash trading and forced liquidation. History showed that eventually one market breaks, and it's usually paper that surrenders to physical reality. But timing that transition, positioning before it occurs, required accepting that certainty was impossible, that risk was inherent, that both scenarios remained viable until proven otherwise. The New York session would provide the first critical data point, not the final answer, but the next piece of evidence, in a puzzle that would take days or weeks to fully resolve. When safe haven assets move like speculative instruments, when physical and paper markets completely disconnect, when premiums hit 95% while COMEX shows $83, the message is clear. Something fundamental is breaking. The only question that remains is whether what breaks is the paper price suppression mechanism or the physical supply chain itself, because one of them will break. History promises that timing remains unknown.